Welcome to Health, Wealth, and Legacy. I'm your host, Sam Abdallah. Our goal is to bring leaders, thought leaders, education to inspire, empower, and motivate you to expand your mindset, grow, and live your best possible life in the areas of health, wealth, financial freedom, and legacy. All right, welcome to the show. I'm here with Dylan Suitor. Dylan's true passion is to create generational wealth for his family, friends, clients, whether investors, investing in duplex, triplex, multifamily, creating financial freedom, and helping people expand their portfolio. He's also a leader and operating principal investor of Elevation Realty, Keller Williams, having a positive impact on agents and the brokerage as well as his team. So welcome to the show, Dylan.
Thanks so much, Sam. Very nice introduction.
Thank you very much. So tell us a little bit about yourself, your backstory. I know you've been with Keller Williams for a while, and you've gone into Elevation Realty as well as with your team in the brokerage. Tell us a little bit about your story and what got you into real estate.
I got into real estate when I was actually quite young. My mom was a landlord without really knowing she was a landlord, and kind of taught me that from a young age. I didn't know why I was buying property, but I knew that there was a value and a reason to it. I took a jump pretty much in anything I did before I really thought. It was more of like a ready and fire and maybe aim in the future, maybe not even get ready. I like to take action and kind of figure it out on the way. And I did that. I did a lot of education. I spent a ton of time, a ton of money, a ton of time really on education and really developing who I am as an individual, whether that be from the investment standpoint or personal development standpoint. I don't remember exactly what course it was, but I remember way back in the day, my mom brought me to a program that was, some guy spoke, and it was a day-long event. And he said, buy one house a year for 10 years and then let it sit for 10 years. And then you get to retire for life. And that was their whole sales pitch, their whole program. And my mom was like, it's a hoax. It's not true, blah, blah, blah. Fast forwarding to where I'm at now, looking at the number of properties I have and where I'm at and what I could do. And I'm really in a refining stage, given the current economic times we've been in over the last 18 months. And I'm trying to simplify my life, bring it down, boil it down to what I really am passionate about. And what I've recognized that I'm very passionate about is small groups, small influence, big influence on small groups, and going really deep in creating wealth for those that want to really create wealth. Doing a lot of this podcast and presenting and sharing outside of that on my story and how I kind of got there.
That's great. There's a lot to unpack there. So you went to a program, you realized that now you're in a refining stage. Tell us a little bit about your portfolio now. I know you've scaled quite a bit. That's kind of what you're known for is scaling fast and using, money to create a big portfolio. Why is it important for you to refine now and simplify? What does that mean to you? Our wealth creation partner, 33/7. 33/7 creates wealth for entrepreneurs. They've used financial structuring to 10x families' net worth. Now we show others how to do it. They make rich entrepreneurial families richer. For more information, visit 337.com to learn more.
Over the last 10 or 20 years, I mean, we're sitting here in 2023, and over the last 10 or 20 years, return metrics have been blown out of proportion in Ontario and in Canada and even North America. Whether it was money in the stock market and those FANG stocks that went up thousands of percent, or we're talking about real estate that kind of went up 10, 20, 30% a year. That's not standard. When you look back over history, look back over time, you look back over all of humanity, 10, 15, 20, 25% returns are not standard. If you can get 7% on your money over the course of your life, you're doing really well. That's based on hundreds of years of history. And I think that's where Warren Buffett talks a lot about, if you want to learn how to get really wealthy really fast, I'm not your guy. But if you want to figure out a way to make long-term generational wealth, let's have a conversation. And I think what people need to realize right now, including myself, and this is the realization and the refining I talk about, is the gravy train we had for the last 10, 20 years cannot be expected in the following 5 or 10. And those who are so attached to that instant gratification that this world now lives in are likely going to find themselves in challenging times. And I think that education, reading, seminars, coaches, that's where you get information, whether you like to hear it or not. So often I've had coaches or books tell me certain things that I'm like, that's not what I'm dealing with. I'm 33 years old. There are people much smarter that have done what I've done and gone through what I've gone that I can listen and learn from. And for me to not do that is kind of ignorant. And I'm at a point in my life now where I've actually capitalized on this wave that has been going for so long, to the point where over the last 18 months, as interest rates have gone up and changes have happened, I've been able to juggle, but we're in winter. We're in an economic winter.
Yes.
We're in a social winter. And usually our seasons go in 20-year chunks. And the beginning of COVID wasn't even really the beginning of it. It was even before then. And COVID just really created that pain for a short period of time. And then it turned into a lack of supply, which then turned into a booming demand. And we really need to look at that and go in deeper into that and say, okay, what does history tell us? And what are we going to see over the next 5 or 10 years? And a dear mentor and coach of mine, I was at his house earlier or in May, Tony Robbins, talks about we're probably halfway through this current economic winter. And so I was even looking at some of the metrics on MLS today, being June 1st coming out, and looking at the metrics, noticing that we kind of had a fall off from last February 2022, straight down. And then we saw it kind of bounce back, really because supply levels were just too low. And so we saw some spikes in prices and a bit of an overcompensation both sides. And I noticed that in June, we actually saw a decrease average price across the board. And usually that happens where you see a fall and you see a bit of a bump and then you see another fall. And I think that if we assume that the worst is behind us and we don't plan for what could come, we'll find ourselves reeling. And I'm not saying all this to be doom and gloom or to be negative or to tell people like the worst is yet to come. I think it's more about awareness. And that's what the education that I've gone through has taught me, is we have to be a little bit more conservative than we're in this social community thinking that everything's going to be the best thing possible and we're going to boom everything, right? And so being aware of the downside and knowing the downside and educating yourself on the downside so you can protect yourself from that. Because right now, creating wealth isn't just about increasing numbers, it's about decreasing losses. It's about tax minimization. It's about loss minimization. If you're gonna ride this wave up and you're gonna take stocks or real estate and you're gonna leverage it, then you're gonna get a much bigger return. But when that turns the opposite way and it's leveraged, you also get a much bigger loss. And I think it's really important for people to recognize that 100% gain, so take $100 and go 100% more, that's $200. When you go back to $100, it's only a 50% loss. So when you see that negative return, it's actually emphasized at 2x. And if you have leverage, it's even more than that. So really being aware of what that means to you in your life and your career and your business, and then positioning yourself and educating around it, right?
So what does that financial education piece look like for you right now? Because I believe you're known as, scaling massive apartment buildings and raising private money. And that was definitely worked for a while. And now you have to be more selective on how you adapt your approach. What are you doing now? And what are you teaching your people, your students, your clients as well, to how to mitigate risk and also how to still create financial freedom as well?
Yeah, I think that when I talk about mitigating risk, like I have 19 properties now, maybe I think it's actually 20. I realized one was off the list in kind of the south, that I call it. Like we have a lot of properties up north, a lot of properties in the south. When I talk about my one partner, and we have 19 or 20 properties that are in Hamilton, Brantford, Welland, St. Catharines, Niagara Falls, Fort Erie, so on and so forth. Some of those properties are incomplete. They're not highest and best use. They don't have peak rents. They don't have peak tenants. They may be vacant. Mm-hmm. But for us to spend the capital it's going to cost to renovate those right now puts us behind further. So as much as I could put $300,000 and have a brand new duplex, if I sell it now, I save my potential loss if I keep it. So it's weighing that part out. And so common in real estate investors, we go, I'm going to buy and hold it forever.
Yeah, you think about that. You think selling is losing and you shouldn't, you should keep it forever and you can refi it tax-free, but they don't talk about reservicing that debt, right? No. And how that affects clients and what they're doing. And a lot of inventory coming up now with single family homes, landlord challenges. I spoke with Kayla on the Ontario Landlord Watch. So that's a great point. So you have these properties right now that, are not complete. How is that affecting your strategy of what you're doing next, your strategy to pivot when it comes to real estate investing, still being a good vehicle, but also figuring out how to be smarter with, your portfolio and not.
Let's get a little more statistical then.
Sure.
I'll start off with a bit of fun.
Yeah.
You ever played the game Monopoly?
Yes, many years ago.
What's the goal of Monopoly?
To get the hotels and trade up for a hotel, I believe.
Right. So you go around the board, you roll dice and you collect money and then you buy these properties just blank properties. And then as you do more, you accumulate more, and then you buy houses on these properties so you can collect rent. And then you buy a second house and a third house and a fourth house. And when you get to 4 houses, then you cash in all your houses, you get an apartment building, and it gives you the most rent.
Yes.
I'm going to my clients right now playing Monopoly.
Got it. Okay.
And the reason being is that with the current bond yields and the current debt market, Bank of Canada knows that they have to slow consumer spending. We cannot see 20%, 30% appreciation on housing anymore. So what they do is they increase the Bank of Canada rate, which is based on the bond yields to a certain extent, but it's also very political. Whereas in commercial and in multifamily financing, when you're dealing with CMHC, for instance, those are based on the bond yield trading and then a premium on bond yields. There's no politics there. It's just straight. What are the numbers? What could you go and buy a Bank of Canada bond at? And what could you buy a piece of the Canada debt market at? And then the banks will say, well, we can buy it. We're going to buy it at 4% or whatever that is. And we'll add 75 basis points. Well, my rate differential between commercial properties right now on a refinance and residential properties is almost 3%. So we were talking about 1.5 or 2% interest rates only a couple of years ago. And I'm telling you a 3% differential, more expensive in the residential space. That's not to mention the fact that on the CMHC financing commercial space, you can get up to 50-year amortization, which means you can get twice as much debt on a lot of properties. Very high level. I'm not going to say that's a fact.
Yeah, no.
25 to 50 year, let's just call it twice as much debt. Okay. So not only can I get twice as much debt, I can also get much better cash flow. So I have a client who has a triplex, has a duplex, and has a single family. She bought them late 2019, early 2020. And through COVID, of her 6 tenants, 4 of them were not paying at certain times.
Right.
So I reached out, we had a conversation, found out that she had a bunch of vacancies coming. One person just left yesterday, so we had a listing going live today. And another one's leaving end of June. It was a duplex, 1 vacant, and then the 1 tenant's leaving end of June. And then she got a triplex that we just placed 1, but still there. So we took those 3 properties and she was able to net $797,000 profit after taxes and after realtor fees on the sale of those 3 properties. That gave her 20% down payment back that she paid in 2019, 2020. She didn't make a ton of cash flow over that period of time, but she was able to net just under $800,000 profit in 4 years. We played Monopoly.
So you're leveraging the system to allow, better financing options, and you can use that money towards buying bigger assets that have less risk and more people paying them down as well.
There's a couple things. Now, she sold those 3 properties with 6 tenants, and in 4 years made $800,000 profit. I gave her 20% down back. So the money she borrowed from line of credit or from cash that she had, she got back. Plus, we were able to turn that $800,000 profit in 6 units into a 12-unit apartment building, take it straight to CMHC for financing, and with $401,000 net of fees and all that stuff, close on a 10-year mortgage. This is a 10-year fixed rate mortgage. And she got it for 4.5%.
Attention corporate workers and young families, are you thinking about building wealth in real estate investing and don't know where to start? Build My Legacy Now can help you purchase your first investment property with confidence. Our guidance will set you on the path to financial freedom and secure your financial future. Don't wait. Visit buildmylegacynow.ca to learn more about getting started in real estate investing today.
Now, those 3 properties she had locked in, but they were coming up for renewal next year. So when you go from a 2% interest rate to a 7% interest rate, she was going from $4,000 a month in cash flow to $5,000 a month in loss.
Yes. Yeah.
Well, we just locked in a 10-year mortgage. And we know that rents are going to go up.
Not a 10-year amortization, a 10-year mortgage. Yes.
A 50-year amortization,
right,
with a 10-year locked in rate.
Yes.
So now she has 10 years at 4.5% on a 50-year amortization. And then we have another mathematical equation that essentially states that you have your expenses, and then you have your mortgage, and then you have your profit. Well, if you're locking 10 years of that mortgage in and your expenses are heavily on the tenant, when you do the 2.5% rent increase, give or take each year, that goes straight to bottom line profit. And on $100,000 in annual rental income, that 2.5% is $2,500 in extra rent. So per 100,000 over that 10-year period is just over $70,000 a year in extra cash flow.
That reminds me of the example that I believe at the multifamily conference they brought up over, I believe it was 5 or 7 years, that 3% made a massive difference on the NOI, which increased net operating income for the audience and increased the value quite a bit of that asset. Is that
That's
right?
with no tenant turnover and no
Yeah,
renovation.
no tenant turnover. That's just simple 3%. So bigger impact, bigger asset. So that's a big, that seems like a big message there.
Per 100,000 of gross rental income on an annual basis, we're operating at about $6,000 profit, which isn't much. $6,000 a year is not much. But after 10 years with no tenant turnover, no additional CapEx, you're looking at about a $70,000 to $80,000 per 100,000 annual income on that property. Now, just keep in mind, after 10 years, you can either renew that mortgage as is, or you can do a new mortgage higher. So you either do an equity strip by another property and then play the same game of Monopoly, but in apartment buildings, another 10 years. This is her retirement plan.
So with her, that being her retirement plan, what is she, you said, what is she making per year now? At least she's in the positive, because she would have been very much in the negative. A lot of clients are doing that. They're much in the negative and they're having to switch their strategy. Where is she at right now per year for cash flow? Because it's not getting eaten up by a repair, at least with a single family, it does. But where is she at right now?
On this 12-unit building, we got about $240,000 in income annual. So she's going to be netting about $12,000 a year, $15,000 a year in positive cash flow. Now that's just based on the CMHC underwriting. She also she has to use a 4% repairs and maintenance. This is a turnkey building that just had a new roof, a new boiler, new windows, new renos, everything's done. Repairs and maintenance is nothing. So that 4% of your gross rental income is now bottom line income if you want to use it that way. Additionally, we're talking about there's two tenants that can go from $700 to $1,700. That's an extra $1,000 a month that would be net $12,000 a year times two, $24,000 a year that we can add. Plus we could add extra parking costs.
Right.
Plus we can add laundry. We had all these extra things we can add in to increase your income. What it really comes down to is that we go back to the first part of this conversation, which is the downside protection being more valuable right now than the upside opportunity. And I think if I could get one point across to your listeners, I would say your downside protection is more important in 2023 and 2024 than the upside opportunity you may have.
And to your point too, rather than thinking I'm going to keep it for 30 years and this is how I have to keep this single family home, it seems like to me with what you're saying, and I spoke with Kayla about this, government programs are not helping the single family small landlords right now. And so people could argue, whatever, and not get down that rabbit hole, that there's more government that will own that housing. What do you say to someone who's looking at getting into multifamily space, looking at doing this? What do you do to give them the confidence? And secondly, how would you allow them to have the confidence knowing that government policies won't change the multifamily space soon, right? Like, because, that's a good point, right? 10 years. How do we know that government's not going to change that? What are your thoughts on that? And without getting too political, but you see trends, and I know Tony Robbins talks about this too.
Pattern recognition, pattern utilization, and pattern creation. That's like ingrained in my mind. So yes, I watch for patterns. A couple of things there. You said number one, how do people get into multifamily, or how can they see the value of that? And number two, you said, what do we think about the government trends in multifamily in the future? So I'll start with the first question. When I first got into real estate, I was getting into real estate because I thought there was an opportunity. I went and I was going to flip. I was going to duplex conversion. I was going to be a realtor for me. I wasn't going to sell to anyone else to do it for me. And then I love working with people and creating wealth for other people. So I kind of opened that up to other people. But I did my first duplex conversion before I sold it. I did my first triplex conversion before I sold it. And I don't mean sell it on market. I mean, sell it to a client. So when I did a duplex conversion, I was the one that went down to the committee of adjustments. I sat in the city of Burlington and went down and learned it. And I heard about people complaining about a tree being cut down and whatever the scenario was. People don't like change.
Selling your home during tough times, whether you're downsizing, divorce, or debt, we understand the unique challenges you're facing. Introducing our specialized real estate solution to help you navigate these difficult times with ease. Selling a home can be overwhelming, and yet our experienced team will guide you through the process, providing personalized strategies to maximize your home's value. Whether you're downsizing, going through a divorce, facing debt, we'll help you sell your home and start anew. Don't let these challenges define your selling experience. Let us turn them into opportunities. Visit our website at affluenceregroup.com to learn more.
Right. So that's a piece that you're going to pick up on quick. That's a pattern you can recognize. People don't like change. They're uncomfortable with change. They know what they know and they don't want anything else.
Got it.
So I knew that if I could go and do it, and I could show it, and I could share it, and I could show what I'm doing, that other people will buy into it. So I did. Duplexes, triplexes, fourplexes. What next? Well, we need to get into the 5+, the commercial space. Well, then an opportunity came up for a 32-unit apartment building. I was terrified. But I said, if I'm terrified now, how are clients ever going to trust me if I haven't done it first? So I got into a 32-unit building. And then I got into up another dozen or so smaller, 6, 8, 12, whatever that may be. Then I got an 88-unit apartment building and a 60-unit apartment building that were converting some commercial to residential. Then I raised millions and tens of millions and hundreds of millions in capital. Then I said, what are my biggest problems when I'm doing multifamily? Tenants, tenant management, renovations and managing contractors. How many times do you know of a contractor that's gone over budget? How many times do you know they've gone under budget? Never. So they always go over budget. So how do we micromanage them? I'm like, well, I need a project manager for that. Then we're worried about payments. Okay, well, if I'm going to pay someone a contractor a deposit and then a finished payment, that's one thing. If I pay them on a weekly basis, as I have my project manager go on a weekly basis and inspect those sites, I know a lot more of what's going on. So then I have a controller. So my financial controller pays on a weekly basis, essentially a much stronger bookkeeper, but not quite an accountant. So they do all their books, but they also manage your money and give you some advice on it and work with your accountant to do that as well. Then I had a couple of asset managers I brought in-house, people that were going and doing all my reports. So they'd get an energy efficiency audit, they get appraisals, they get environmental inspections, BCAs, DSS. Like we'd be doing what we need to do to make sure we're getting the highest and best use. Then we'd be modeling those. We'd be taking those to different key partners. We'd work with the city. We'd do some conversions. We'd find what grants were available. And I'm looking at all these things that I'm doing for me and going, how is the average person that did a duplex conversion with me ever going to do this? The simple answer is they're not. I'd even go as far as to say that most realtors or most advanced investors won't be able to build the infrastructure that we've been able to build.
Well, we noticed too that people are starting to ask about multifamily. They're putting their hands up. And if a realtor doesn't have that knowledge or the experience, it's sort of like if you work at BMW and you drive a Kia, people are not going to believe you because they're like, well, you don't drive the BMW. So how come I'm going to buy this BMW?
But I think the biggest problem and the biggest challenge that I hate to see, and the reason I have the companies I have now, is because the person that drives the Kia will still sell that BMW in the real estate space 9 times out of 10. They'll still drive outside of their area. They'll still put an offer in. They'll put a 5-day home inspection and financing clause in there for a commercial deal. And all they're doing is putting their clients way behind the.
Yes.
Over half of our clients are actually realtors or realtor referrals.
Yeah, that brings up a good point too, because we had a client once where he worked with another 10 agent, and not to get too off track, but he put an offer on a property and he wasn't informed, and he put an offer so much bigger than the appraisal. They had to do a blanket on the house of the parents just to allow him to close. And that has a big ripple effect. So the big lesson is work with the right professional that has the experience and someone who's local in that area as well.
And spend a little bit more time on that to say that blanket on the parents' house, now put the parents underwater, put that guy underwater, and probably put him back 5 or 10 years. So when I talk about the downside protection versus the upside you can capitalize on, the tax man doesn't care that you're going to be behind the 8 ball. You're still going to be paying taxes over the next while. Maybe you can get some capital losses, but you're not going to get ahead. So that 5 years or 10 years backwards is actually probably more like 20 years lost. And that's the risk. And so what I ended up saying is I had a couple of clients that were doing some projects, and this was when I first got into it. And I learned this lesson really quickly. And I said, I'll never do that. I've actually bought 2 of my clients' apartment buildings off of that client at an inflated price to finish those projects and take the hit, because I feel like I didn't service them properly when I sold the property. Now, I know that I've done a really good job. I know that I've educated. I was there along the way, but I feel that I could have been better. And so instead of ever feeling that way again, I launched 2 extra companies. I launched a property management company, Grow Ontario Property Management, and I launched an asset management company that I'm very proud of, which is Conduit Asset Management. And the whole goal of Conduit Asset Management is a 4-phase pricing model to do due diligence all the way to full completion of properties and assets without an ownership share. We're essentially a 50-50 joint venture partnership that a lot of people would know about, but very educated on it, with a massive team that does it, with incredible communication skills, with the ability to tap into all of our different resources and share that with people and get turnaround times in 50% of the time or 50% of the cost for the clients. And instead of charging them 50% of that asset for life, we charge a set fee upon completion based on the refinance number that we get.
So break down that's interesting. So when you talked about the conduit Asset Management. Is that the company? Cost
Yes.
Asset Management. So how does that solve problems? It seems like it solves quite a bit of problems for people buying apartment buildings. Can you break down the structure of how that works for someone getting into the apartment building space and what problems that those two companies solve?
Let's go back to Monopoly.
Mhm.
Buying a couple of houses and buy a 1,000 square foot bungalow, Kitchener, Waterloo, or Hamilton, or where you want to talk about. But you buy a 1,000 square foot bungalow. I mean, now what are they at? $700,000-800,000. You spend $200,000 on it. You refinance it for less than your cost is. Doesn't make any sense, and you're negative cash flow.
And
But if we go back to 2018, you'd buy it for 400,000, but 100,000 in is worth 6. You made 100,000 in equity. You had positive cash flow, and quite frankly, you had one contractor and didn't have to manage a whole lot.
and you had a refi that was a guarantee.
Yeah, it was a slam dunk.
Yeah.
So we were like, okay, all day long, let's do these all day long with a 2% interest rate.
Mhm.
Well, now what we're finding is those people are coming up for renewal this year, next year, the year after, and I'm saying instead of renewing your mortgage, let's sell that duplex, and instead of $1 million, maybe it's 900,000, whatever that is, but you're still making $300,000 profit from those people that bought it in 2019 or 2018. Now they're going to sell it. They're going to say, I got $1 million or $2 million that are sitting on the sidelines. What do I do with that? And I'll say we can private lend it, invest it in a group fund, or you can actually use our asset management company and take full advantage. Grant Cardone talks a lot about this. He talks about 10x.
Cardone Capital.
But the people that invest into Cardone Capital as a passive person might 2x.
Right. I remember.
They're not 10xing. It's the active part of it.
The active,
it's getting involved in actually owning the asset that can 10x. You want to get that exponential return, it's buying it.
So
but most people can't do it because they don't understand what the permitting process is, what grants are available, what professionals to use, how to manage contractors on a weekly basis. And if they do understand it, they're leaving a lot of money on the table because their timelines, they initially budgeted 6 months and it takes 18 months.
Gotcha.
So what we do is, because of the fact that we've managed over 40 properties in the last 2 years that are multifamilies, highest and best use, they get access to our architects, our contractor quotes, multiple quotes on every single one, our insurance quotes. They get access to our agent, our lawyers. They can do share purchase agreements. They can buy and bring your capital costs down. We have access to all the energy audits and appraisals, environmentals, BCAs, DSS, like all these reports that we can gather to ensure we get you the best financing. If I go back to that 30-unit property that I bought, we ended up closing it in cash and did all the renovations in cash because I didn't understand commercial financing. I also bought a property for $9.5 million that we closed in cash. And then my first financing structure came 6 months later for about $6.5 million. My most recent financing structure that I could have gone straight to them with closed in December at $10.2 million as the first draw, without much more done than when I bought it at 9.5, which is over 100% of what I paid for it. And then they gave me up to $7 million in construction. So I had a $17 million pre-approval on a $9.5 million purchase with construction draws. I can tell you right now that you can scale a lot faster and a lot better when I can get you into that kind of conversation. So I can take people that are doing these 3 or 4 duplexes and I can get them into a much smaller, maybe remove a 0 from what I just talked about, but a smaller apartment building, we can turn them over every 12 to 18 months. And we can ensure that you don't hit the same pitfalls that I've had or a lot of other investors have.
That's awesome. So yeah, definitely leave some information on that. It seems like you've launched this. This is one of the things you're launching as well with this company, and how it's going to help people trade up in the monopoly space, if you will.
Well, Conduit Asset Management is actually a company that I launched for me, that I use it for clients that are looking to get into this space. I have a lot of realtors that come my way, a lot of the top, most successful realtors. Like I have the #1 realtor in multiple cities, not in KW, but outside of that are actually working with me right now to either give me capital or working with me or sending clients my way because they go, this guy knows what he's talking about. And we do. We have a very strong team behind us that are very well versed in this, that have a lot of experience in this. We're in the process of hiring 2 more asset managers and another controller. I really love this business. It's really where the future of wealth creation is. And it solves a problem that we can go into as your second question, which is, will the government get into that space?
Well, you brought something interesting up and you said people don't like change, and that is a good pattern recognition. And I believe that with single family and changing to duplex, triplex, you're creating more change and there's more resistance. So I feel like when you're getting into the apartment building space, that seems like a more natural flow because there is a need for housing, and it just seems like a better space to be in.
People don't invest in real estate because they don't understand it fully. The benefit of what Conduit does is we're your insurance. We're the ones that help you understand. We hold your hand as if an active partner would in a 50-50 partnership, except we don't take half of the asset.
So what does that structure look like when it comes to investment of the client? So that's one question. Second question would be, clients going to invest or trade up some assets to get into the multifamily space. We know that there aren't as much, I guess, permitting when it comes to triplex conversion. You have to get, drawings, and then you have to get permits approval and all that minor variance potential. What sort of things do they have to be aware of if they're doing it on their own? And then what are things that you guys would be helping them with? And what's that structure look like when it comes to the breakdown? Because it's not a 50-50. And I think people are sometimes hesitant to invest in joint venture partnerships if they don't know the partner has a track record, or they just, they're just hesitant in general. So what are your thoughts on that? And it's a loaded stuff here.
We have a 4-phase pricing model. Phase 1, phase 2, phase 3, and phase 4. Phase 1 is like your conditional period through due diligence. We usually see 30 to 60 days for due diligence. This is where we're going to get all your reports, submit for financing, so on and so forth. You can't submit to CMHC in this period of time. You'll need closer to 5 or 6 months right now. So you may need to do some sort of bridge financing or interim financing solution to get to CMHC. There are sometimes we've been able to negotiate 5 or 6 month conditional periods, which are awesome, but we want to make sure that we want to make sure you have the proper due diligence. So that first phase is the cheapest. It basically covers our cost, and we're the ones that gather all information. We cross-reference rent rolls. So we'll say, okay, well, give me the rent roll you have, get it certified. I'm actually going to go and confirm that those are the true lease numbers. We will go and verify square footage. We'll verify a lot of information. And I don't necessarily think that the realtors or the sellers are trying to misrepresent in multifamily. There's just a lot of things that people need to pick up on. And maybe I looked at my bills over the last 12 months and I double counted one or missed one. Like there's a lot of honest mistakes that happen in that.
100%.
But we're the ones that catch that to make sure that your true NOI is your true NOI. Then we look at different financing structures and work with our lenders to get you there. Within that 30 or 60-day period, that is our first fee, our phase 1 fee. It's the lowest. And again, it's cost. You can come and see us at our booth at the event we're throwing August 1st that I'll talk about at the end of this meeting if you want to kind of get more details, or you can book a one-to-one with me on it. Phase 2 is once you've gone firm, everything else until closing. This is usually setting up a new corporation, getting some tax or legal advice. This is going to be getting your permits submitted to the city, because you can do that before closing. We may be negotiating with some tenants if there's an opportunity to cash for keys, or if there's a way to help move a tenant from one unit to another at a better rate, or whatever it may be. These are where we're going to get involved in the actual building. We're on board the building, and this is our onboarding fee. This is phase 2. Again, it's not much more than our actual cost. And we're going to make sure you're positioned that on closing, we can get right into renovations, or at least we're in the best position we can for that. And we're moving along the process because we want to finish this project as fast as we can for you and for us.
So you help to do the due diligence in phase 1, the conditional, verifying the rent rolls, NOI. You probably have a structure in place of how much you're going to turn over the building and increase the NOI, I believe.
Strategy. Yeah.
It's 5 to 6 months for CMHC. So you figure out some kind of bridge until then. And then phase 2, there's a firming up process. Believe
well, if you affirm on the deal, like say you're after your due diligence in a deal, just like a regular home, you buy a duplex, whatever, 5 days on finance and inspection. We do 45 or 60 days on all that stuff in this with a lot longer list. But once you go firm, you don't close that day. You close a month, 2 months, 3 months later.
100%.
So that 1, 2, 3 months, there's time there to start implementing your strategy. And that's really what that second phase is. It's the implementation of the strategy. It's involving legal, it's involving accounting, it's getting your corp set up, getting your family trust, whatever we're talking about doing, getting that done, getting an SPA, share purchase agreement finalized, making sure we've hit all the financing check marks. It's just because you got a letter of interest or a letter of intent from financing isn't a commitment. Until you get a commitment and close, that deal can still kind of require more stuff. We'll manage that whole process.
So it seems like you're putting wealth under all one umbrella, really, and you're helping people set up the corporate structure to understand how to create the wealth, how to manage the wealth, buying the buildings, the due diligence, also being the realtor portion, which really helps, obviously, and understanding due diligence, environmental, all that type of things that the client doesn't really know when they're buying an apartment building, right?
Everything that I've done that I've learned from, like, I mean, I heard my favorite thing in the multifamily conference this last week was I have a master's in failing, but a PhD in getting back up.
Absolutely.
And I think the PhD in getting back up is the critical part that I've never heard before, that I was brilliant. And that was A-Rod that stated that. And I think what I really love about that is the PhD means you've actually learned from your lessons and your problems. So everything that I've done, the path that I've done, over 1,500 doors across Ontario that I've had in the last 6 years, through single families all the way up to 80 unit buildings and soon to be over 100 in a couple of properties, you get all of that. And it's all documented with teams, with people, with really good professionals. Not to mention, because it's me coming from me, we do so much of it, your pricing is 60, 70, 30% off, and your timelines are turnaround maybe 2-3 weeks faster. So we can move this stuff along faster. Plus, you're going to get the best advice because of the fact that it's coming within my ecosystem. So that's really the idea of the whole picture.
You mentioned too about your lessons, like, you know, at some point you've maybe taken on more leverage. You're now focusing on managing the downside. What did you learn from that process of taking on leverage a little bit faster, and now we're, you know, having a huge portfolio and now learning how to manage downside and helping clients build wealth that way? It seems like it's created and birthed these companies, which is allowing the wealth to go under one umbrella, and kind of demystifying wealth, because I feel like people aren't taking action because it's kind of unclear, you know, like corp, and do I put 5 in my property, then 1 in here, then 1 in the corp? Like, you know what I mean? There's a lot of ambiguities there.
We could spend days and weeks and months going through this. I've spent years going through this. And you know, they talk about 10,000 hours to mastery. I think I master something new every 2.5 years. It's not a 2,000 hour work week for me. Like, my life is real estate. I eat, sleep, breathe, drink it. It's everything I do is real estate. And so I think that I share those, and I share those through my teams and through my people and through what I have. And I think that's really important. There are a couple of things I definitely want to get to is kind of finishing those 4 things. I only talked about 2, but then also going into the political side of things without getting too political. So phase 3 is our construction management. Now, that fee is where our project manager will come in, and they're actually going to get multiple quotes from trades and contractors, whether that's an all-in-one contractor, or we're going to hire a drywall and an electrician and a plumber, so on and so forth. And they're going to manage the application for permit. So he's going to be there. He's going to be on site every single week. As I kind of mentioned, we have 2 of those project managers right now, soon to be a 3rd. And those people are on site every single day, every single week, approving payments nonstop, taking calls, taking pictures, whatever that may be. So that's our phase 3. And then phase 4 is where we actually make our money. And that's it. We get a percentage of the after repair value on refinance. Now, I can't quote you an exact number on that, but I can say the highest we charge is 10%. So it'll be 10% or less of the after repair value. So say I get your building to $5 million, you'd be paying us 500 grand or less. And there's a couple different ways. We have an aggregate pricing model that's over a lifetime. So the more business you do with us, the cheaper your pricing gets. And then also, if you want to structure a purchase, or you want to pay some of that fee up front, we do a discount as well if you pay up to 75% of the end value up front, if you have the cash available.
Does that come out after the refinance?
So that's the most important question that a lot of people ask is, okay, well, how do I get this? If I don't have a full BRRRR, what happens? Well, what it comes down to is we're so confident in our abilities to keep our costs down and to net you a better position, even with this. So what we've actually done now is let's say that the same $5 million exit, let's say your total cost was, let's say I got a $4 million mortgage on it. It'd be more than that. Let's say your total cost was 4.2, including our $500,000 fee. We'd take 300 of it, but the other 200 would actually stay in the deal as an NOI, a notice of interest on that property. We would then take 50% of the cash flows. You'd keep 50% of the cash flows until we did our second refinance. That could be a pari passu in a couple of years. That could be 10 years down the road. So we'll stay invested with you in that project without taking that capital for ourselves, knowing that we're committed to making sure that the deals that you have a minimum of 50% lift from the purchase price. So we want to make sure that we can get you the best deal possible and get you into a really good opportunity. We can't predict the market. We don't know what that looks like, but we're the last to get paid other than you.
Yeah.
We're invested in it as if we're partners, but you have an automatic buyout of what that's going to be. And most of our deals, we end up doing a full BRRRR, including our payment. And then you're off to the races and you're managed them usually with our property management or another professional property management company. And we move on to the next deal.
Okay. So it seems like you have a safeguard in place as well, but you're confident in the way you have a plan with the property, increase in the NOI and the lift of the property. So that seems like there's definitely 4 phases that are really important there.
Yeah. So I want to get to the future of housing and government. And I think
it's a
when you say it's a very hot topic, I think when you say that the government's getting involved in the single family or duplex home, I think that what they're trying to do is make it more challenging for everyday people to be investors.
Yes, I agree with that 100%.
They want BlackRock. I mean, as much as they don't like it and people don't like it politically, but they want the BlackRock to own 1 billion homes and they don't want to own them. I truly don't believe the government wants to own housing. I think the government wants to support and subsidize housing because they know they have to, but I think that's going to come in the form of a universal basic income. I don't think that's going to come in the form of free
that's like not to say socialism structure, but some sort of system.
Correct. I think there is a way, as much as I'm a capitalist and conservative, I think there is a way where universal basic income can be beneficial for everyone. And I'm all about giving back and collaboration and togetherness. So I'm absolutely in favor of that. I want to make money. I want to know that I don't want everyone to be equal, because I think the people work harder than others, and I think those people need to be rewarded for that. But I also think that everyone deserves a home, and they deserve food on the table.
Right.
So I think that there's a blend of how we can make that happen. And I think we do a lot of that through the charity give back, and we do a lot of charity work. We have an event coming up August 1st, where there's a big charity component as well. And we're going to have all my companies along with other companies that'll be out that event. We'll talk about it in a couple of minutes. But I think the big thing is that what I actually do see happening is I see the government clamping down on single family duplex, triplex, so that more people can own homes. And so I think where I actually see things going is I think that we're going to see more of like an ODSP type thing, but I think it's going to be direct to landlords at some point in time for apartment building owners. And I think that there's a unique opportunity. Like, we're moving more towards a renter's economy. And I think there's a unique opportunity right now where people can still get into the multifamily space if they take action. I have a number of clients that have already done it. I have a number of agents that have been like, hey, if I sell my clients duplex, triplex, condos, whatever, can you get them into an apartment building so I know they're protected and cared for? Absolutely. We do a lot of that. And I mean, I'll work with a lot of agents on making it work, and our whole team will, whether we do the listing or you do the listing. It doesn't matter to me, as long as we're helping our clients build wealth and get ahead. Right. And so I think that there's going to be an opportunity to get into that space. I think we might need to be a little bit more conservative on our return metrics, thinking that I can do a buy, renovate, refinance, make $200,000 and move on to the next, and still have equity in a property with positive cash flow. Those days are kind of behind us. I think interest rates are not necessarily going to stay as high as they are, but I think they're probably here to stay in the 3, 4, 5%.
Yeah, when you look at the 30-year trend from the conference, it shows, right? Those 2 years were an anomaly.
Yeah, we're not going to get 1%, 1.5%, 2% rates. That's a COVID mistake that I think the government recognized and realized. But I also don't think we're going to get $2,000 a month ever again, because this was almost an introduction to universal basic income through COVID that ended up realizing, hey, we have a bigger problem when all of a sudden people are spending crazy.
Yeah. Well, it reminds me of the book of The Creature of Jekyll Island, the U.S. Federal Reserve, how that was created. And it's very interesting stuff, right? When you see money getting printed like that. So
the money supply is negative for the first time since 1930. If you don't know what I'm talking about, go check out M2 Money Supply and see what happens when money supply goes negative. I'm not going to get into it because
there's a lot of golden nuggets for our audience, and we got a couple minutes to wrap up, but I really appreciate your time and sharing this. So this is what you're working on right now. Any closing statements, anything you'd like to share as well? Yeah,
I want everyone here to go buy a ticket. We have a discount going on right now for August 1st. It's Tony Robbins Business Results Training with Steve Gill and Scott Humphrey. It is $129 with a discount code, and I can drop that discount code for you at some point in time.
Yeah, send it over. We'll have it in the show notes as well as information on this. And with regards to your team, I know you have a pretty big team, and you would show with your consultations an example of the lift and that sort of thing, and different areas in Ontario that people have invested, actual examples. It seems like this is an evolution of that, because it seems like it's putting wealth in house, and you kind of have phases now that you've organized, which seems really neat, because you've broken down how many times you've done that multi-unit apartment buys and deals, and actually guaranteeing like a wealth result, like an NOI. So that seems like, if I'm right, please let me know. The other thing is
financing is so predictable. You increase NOI. If I increase rents and increase expenses, I know my outcome.
Now, and just as a question, because sometimes you'll hear people say, well, we base it on maybe a 70% turnover. Is it depend on the building? How do you approach that? Because that stops people from investing in multifamily, saying, well, I don't know about these tenants, and this is on the market, but it's got a 50,000 NOI. What do I do? Right. So what do you do to approach that? How do you navigate that? Because I think that's an important question.
So I think, and I'll use the number of 5 cap because it's a really easy number, but
if Kitchener's got 5 cap.
If someone's paying $1,000 a month, that's $12,000 a year. Mm-hmm. At a 5 cap, that $12,000 a year is about $500,000 in value. Now we know there's expenses that go into there. So maybe there's a 30-40% expense ratio. Mm-hmm. We're probably in the $300,000 to $350,000 per unit.
Right.
Now we just use simple math and simple numbers on, like, if you increase your rents by $200 a month times 12 months at $2,400, use a 5 cap on that. That's $48,000 in added value. How can I increase $200 a month? So when you're looking at how you can increase NOI, that's really what you're looking at. What I
Okay.
would say with most people is that if you want to do a 70 or more % turnover, you got to buy it with a bunch of vacancies or buy it off of someone off market that has owned the property for 30 or 40 years and never done cash for keys. Because anybody who's owned properties for less than 5 years has been cash for keyed, and most of them say no.
So what I'm saying, what I'm understanding is you create a map of a plan, say, okay, we're going to make these little changes on each unit, somehow savings, because that increases NOI, thereby increasing the value this much. And then you create a business plan around that. Is that what I'm understanding?
I think the big thing is if you can turn a couple of units and take it to CMHC, you can be the one that gets the cash flow exponentially higher. That's your big ticket exit is 3, 5, 10 years down the road, not in 12 months. So if you start looking at things in 12 months, you're in that same risk cycle because you're going to
Yeah,
use
you're in that same.
private financing and you're exposed.
That makes a lot of sense. Dylan, it's been a fantastic conversation. A lot of nuggets. Wrote down a whole bunch of questions, and I think these were even better because I feel like we just went organically into that. So we'll leave your information in the notes about your team, your brokerage, as well as if anybody is a realtor that's interested in working with you on your team or at your brokerage in the Oakville area, correct?
Brokerage is Toronto, west side of Toronto.
Toronto, that's right. Okay,
Yep.
perfect.
Yep.
Right.
And then I will also say, like, there is a couple of booths available still for the the business results training, which is coming up August 1st. Highly, highly, highly recommend getting there. It's going to be a massive discount for UPW if you've ever wanted to go to UPW as well. The focus of that event is the morning is going to talk a little bit about overcoming some of the challenges you're dealing with right now in society, in the economy, and how to prep yourself best for it. And the second part of it's my favorite. It's a 10-10-10. It's 150% growth in your business and how you can apply some very basic systems to your business for 150% growth in 2024. Now that's kind of the opportunity. The biggest opportunity you can have is in your business and in what you do with your time. That's where you're gonna get the biggest ROI in the future and the safest, because you don't need to worry about taking as much risk as you would in buying these big investments, whether it be apartment buildings or stocks or whatever that may be. So there's a discount code for 20% off, pod !1, and we'll share everything else in the notes.
Awesome, Dylan. Thanks so much. Appreciate it. Great conversation today.
Thanks so much, Sam.
Thanks, buddy.